putting everyone.
More than I expected.
Keep coming in, keep coming in.
Yeah, this is great.
Hey, hi, Lynette. Everybody.
Hey, where's Lynette? Hi, Lynette.
All right. So good afternoon, everyone.
Classmates.
Kelly. Good afternoon, everyone.
Sorry.
And welcome to the Grand Rounds. I'm Liz Reberedo, a collaborative attorney, and together with Kelly Forrest, we are co-chairs of the Grand Rounds that is part of the FACP Outreach Committee. We are pleased to present the March 2022 session of the Grand Rounds, a monthly lunchtime training showcasing a different Florida collaborative practice group each month. The first portion of the session will be a group presentation, and the balance will be a discussion period where we'll troubleshoot and brainstorm solutions to the unique problems presented during the session. If you have questions during the presentation, please place them in the chat and we will kick off the discussion period with them. Once the question and answer session begins, please raise your hand by clicking at the bottom of your screen in the reactions box when you would like to speak. If your practice group would like to present at a future Grand Rounds, or you would like to submit an issue you've had to address in the collaborative process, whether substantive or process-based, with a short fact pattern for us to use as a foundation for future sessions, you can email them to me or Kelly. We will place our email addresses in the chat. We will not be having a Grand Rounds in April due to the UN World Creativity and Innovation Week happening between April 15th and April 21st. As you may have heard, the theme is collaboration, and FACP practice groups will be taking this amazing opportunity to promote the collaborative process in creative and innovative ways. Please check on the FACP website and social media pages for information on what is going on and how you can participate. Thank you all for joining us. I am happy now to introduce my friend and co-chair, Kelly Forrest.
Thanks, Liz. And thank you all for attending today's session of Grand Rounds. And I'm happy now to introduce our presenters from one of the Tampa area's practice groups, Next Generation Divorce. We have Matthew Thatcher, who is a partner at the Solomon Law Group in Tampa. Matt has been board certified in marital and family law since 2009 and has been practicing collaborative law since 2016. He is currently serving as one of the two co-chairs for the Next Gen Divorce Collaborative Practice Group and is a graduate of the first class of leadership fellows from the FACP Leadership Institute. He was also my partner throughout leadership and is a great friend and teammate. So thank you, Matt, for volunteering for today's session. Rachel Fisch is a CPA and Accredited Business Valuation and a collaborative financial neutral. Her litigation support experience includes business valuation and forensic accounting for estate, commercial, and family law. And she has over 17 years of experience in accounting, audit, and related advisory consulting services. So hi, and thank you, Rachel. Brad Cantor is the founding member of Cantor and Associates PA, CPAs, DBA Cantor Consulting Group. The firm performs individual and corporate tax preparation and other tax-related services up to and including representation in tax court. Brad is a CPA in both Florida and in DC and is certified in financial forensics, is a certified fraud examiner, certified valuation analyst, enrolled agent with the U.S. Department of Treasury, master analyst in financial forensics, and holds a master's in accounting, specializing in forensic accounting. So thank you so much, Brad, for being here. We're looking forward to your expertise. Thanks to all of our presenters today. And now over to Next Gen for the March 2022 Grand Rounds.
Well, thank you very much, Kelly, for that kind introduction, and Lizette as well. Thank you for inviting us to be here. We are very happy to be here today to share the exciting topic and timely topic of taxes, being that next month is the initial tax filing deadline for most individuals. As most of you all know, when we're going through these collaborative divorce cases, taxes and finding out what people's incomes are is essential to figuring out what the support should be and what the child support can be paid. And when you have individuals who have companies, sometimes that gets a little tricky. And so we've got Rachel and Brad to help walk us through a business tax return and help identify the things that we should be looking at and be aware of so that we are better informed and can better guide our clients through this process to reach the fair and equitable result.
So Matt said this is an exciting topic. I hope that is true for you. But we are going to focus today first on business returns. And the purpose is today is to kind of get an idea for income. We're going to focus on an 1120S corporation, which is the primary one that I see as a financial neutral in casework. So I'm going to show you an 1120S, and so you can kind of get familiar with the tax form. And I'm going to point out a couple areas that they're consistent on the form, so you look for them with your client or your client spouse's returns. All right, so I'm going to share my screen, and just please let me know if it should be enlarged any or if you have any trouble seeing it. So here's an 1120S. I'm going to show you a couple things right off the bat that will help you get a good understanding of the business. So this tax return, you'll see over here in the right-hand corner is a 2020 tax return. And that's where it says 2010 up here in the S election date, which is the same as the date of incorporation. Sometimes those dates are different, and that might make a change on how you look at the tax return. But in this instance, they're the same date. The next thing that's important to know is the business activity code. If you're familiar with the NASIC codes, then you would be familiar with this. But if you're not familiar, go to the next page where you get an idea of the business activity and product or service that the business performs. So this will give you really a lot of information about this business right away. Number one, 2022 tax return. Number two, they started business in 2010, so they've been in business for 10 years. Number three, this is a tavern or a bar that sells beverages. So we know a lot about what happened in the world in 2020, right? So that will give you some idea of what this business is being ran, or how robust it is, if it was able to survive that period. So coming back to the first page, this will give you a good snapshot of the income that the business generated in that year. So you have gross income up here at the top, and then you have direct expenses is on line 2 to give you a gross profit. So then the next very important piece is on page number 7, line 7, is compensation of officers. So the compensation of officers is going to be payments to the owners typically, but it's really payments to all officers of the business. Not all officers are owners, but luckily the IRS has another form, 1125E, which you can kind of look at to identify whether the part, your client or your client spouse is the owner, and how much, and if there are other owners in the business. So we can quickly go to that form. So it's 1125E. I'm going to show you that real quick. Got to just kind of flip through it, so bear with me. So as you can see on 1125E, that $30,000 that we saw on page 1 is split between 3 different individuals. One party is 100% owner. I'm sorry, this person dedicates 100% of their time to the business, and they're a 50% owner. The other 2 owners are they give 50% of their time to the business, and they're 25% owners, but they all get paid the same amount of compensation, $10,988 in 2020. So this is an important piece of information for you to know when you're looking at income for the business for your client or your client spouse. Let's go back to the first page. So number 1 question, how much income does this business produce for your client or your client spouse? Is it the 10,000? Okay, keep that in mind. The next thing that we look at is how these other various expenses for the business result in a net income of $20,855. So $20,855 is the profit that the three owners can split up. So something you should know about 1120S companies is that the is split up by their ownership. So this guy was a 50% owner. He's allowed 50% of the profit, theoretically. I'm going to go real quick. I know this is taking a little bit more time than I expected. I'm kind of going a little more detail, but let's look quickly here at Schedule L. This is another big important piece of information that you should have an understanding of when you're looking at 1120S. So this is your balance sheet, right? So when you receive money into the company, or any kind of transactions that happen in the company, there's going to be either it's going to be on the income statement or it's going to be on the balance sheet. So transactions that don't appear on the first page should show up here on Schedule L. We have assets at the top, liabilities and equity at the bottom. A couple things I want that you should kind of look at is changes in these two columns, because we have last year and we have this year. So any changes would result in So one thing you'll notice is that they got a new loan. Their equity has declined, and there's been some other significant changes in their fixed assets, but some other changes in their liability sections. So let me show you one more statement, and then I'll ask Brad to weigh in on his thoughts. Here's the K1. This is for our client, either your client or the spouse. It's the first owner in this case. So this is reflective of his percentage or her percentage of ownership from the income of the business, right? The first page was $20,000, 50% owner, $10,000 shows up on the K1. The other very important piece of information you'll find here is down here, the distributions received $134,000 of distributions from this company. This is an important piece of information that you need to know in order to estimate what the income is for your client or your client's spouse. Brad, what else can you tell us about this K1 or this business return?
Well, great job, Rachel. Some of the things that came to mind was that, attorneys really need to get a good understanding as to the overall performance of the business over those years, to really get an understanding as to how much income it's really throwing off historically. So you'd like to have a series of returns that provide this information that you can kind of develop some kind of trend, because you really want to understand for your client the true performance of the business. Some of the things to be aware of, for example, are this business, if you go to, well, you were there, just page 2. This business is showing that it's on the accrual, Schedule B, line 1. So this tax return was prepared on the accrual basis. Probably doesn't have much of an impact for this kind of business because there's no real accounts receivable. So a tavern is collecting as point of service sales. So they sell a beer, they collect the money. There's no accounts receivable. So it doesn't really impact the sales. But if you have other businesses like manufacturing, where you have sales that were performed in year 1, but you haven't collected the money to year 2, and this tax return is prepared on cash basis, you do not report that income as taxable income. So if you go by the tax return only for the standpoint of income, you are negating some portion of income that was actually generated on a financial accounting basis, not a tax accounting basis. So you want to make sure you understand the difference between the financial accounting and the tax accounting. Financial accounting is, where us as CPAs look at the accrual method of accounting, but a lot of businesses are really small, so they can legally report their income on the cash basis and not report how much they've actually invoiced in that year. So they can legally decrease the value, if you will, for reporting income, and they reduce their tax exposure. So if you just go by that, then you're not really accounting for the full income potential of the business. So that's one thing to be aware of. Another thing to get your hands around generally how a business, is performing is, if you go to page 1, Rachel, you want to make sure that you determine what the percentage of sales numbers are. Rachel made a great point in determining what industry you're in. So a tavern or a manufacturing company or a law firm or an accounting firm are all going to have basically some relative parameters of industry standard with respect to percentage of sales. And percentage of sales is pretty straightforward. It's easy. You just take whatever number you're looking at, for example, compensation of officers, and you divide that by your sales. And that gives you a percentage of sales number. And you do that throughout all the categories. And then you compare that to industry. Because if it's not close to industry, you'd like to get an explanation as to why. Is money being diverted? For example, in a tavern, you could have a lot of cash. Well, maybe that cash is not being reported. So your client is now, if you don't know that, is theoretically going to have less of a value for whatever that business comes out to in terms of evaluation, because you're not aware of really how much money it's generating. The other comment to be made is if you go to page 4 or maybe 5, it is 5, is it? Yeah. If you go down to schedule M2 and you look at line 7, the one thing that's tricky about 1120S's, at least I feel it is, and a lot of people run into this, is that the distributions that Rachel highlighted, that does not get taxed for income tax purposes as dividends, which is really what it is. It's a distribution of value of the business. It circumvents the income statement, so it doesn't get listed as an expense anywhere. It's simply like an owner draw, if you've heard that term before, when you have a sole proprietorship. They just write a check to themselves, but it gets coded to distributions. So there's a certain number of things you need to be aware of on that. One is the distributions have to follow the percentage of ownership that Rachel was talking about on the other schedule. Okay, so you can't just indiscriminately, if you're a 50% owner and there's two 25% owners, like in this case, you can't write yourself a check for $100,000 and then not give them another $25,000. You can't do that, because if you don't do that, you perform, essentially you bust the S corp, because you've indiscriminately have distributed disequity to the owners, and you can't do that. Then the S corp no longer exists, and then it converts to a C corp, and then you have double taxation. So you just really want to be aware that the tax rules with respect to distributions are really being followed, and that's usually a big problem, because that also affects basis, which is what your clients are going to be concerned about at some level, depending upon what happens with that business. So if their value in the company, which is their basis, is affected by income, a number of other things, but primarily also distributions. So if someone's taking an inequitable amount of distributions, their value in the business should be going down. So you need to make sure that that basis, that value that is ultimately determined they have in the business based upon percentage of ownership, is accurate. And many times shareholder basis is not calculated on these tax returns, because it is not technically the job of the CPA, believe it or not. It is technically the job of the owner. Now, when we do our returns, we handle shareholder basis for clients as an example, but a lot of firms just don't have to and don't feel the need to. So when you do a sale, that's when you have to figure out what the basis is, because that affects the capital gains component. That's all I got right now.
Awesome. So we talked about various forms of distributing funds from the business to the owner. And so they have wages, they have distributions, which is not considered income. And then the other thing that is income that the business generates. So you'll have to talk with your team to figure out how the income from the owner of this business should be considered when you're looking at support or other reasons for the income support, obviously. So the other thing that is, just so you're aware of, when there's multiple owners, you have more people kind of, like in this case, you have more people kind of overseeing what's happening in the business. that doesn't always mean that the primary owner, our 50% client in this case, isn't gonna like try to, you know, have some personal expenses run through the business. But from a forensic accounting standpoint, it just kind of decreases the odds of seeing something like that. I don't know if you got there. One other thing that I think is kind of important, it's not super relevant in this particular case. The one thing that you should be aware of is depreciation on line 14 is a non-cash expense.
Good point.
So in some manufacturing companies, as Brad noted, they may have significant fixed assets. In this case, you know, it's just a bar, so they have some fixed assets, which you can find here, but not a significant amount. So when these numbers are large and it's a big portion of the assets, then they have a lot of depreciation, which is a big expense that they don't actually write a check for, a non-cash expense.
Hey, Rachel,
You'll have to keep that in
one
mind.
thing, sorry, one thing I happen to see is if you go back to wages on page 1, I just wanted to mention that one thing to be aware of is the compensation to officers is that they're taking a reasonable wage for the amount of effort they're putting in the business. A lot of times officers will be aggressive about taking only a small amount of wage, maybe to cover the state unemployment tax exposure amount of the $8,000 wage base. And it can be really important depending on what's going on when you're, you know, negotiating a settlement, so to speak, in the collaboration process, because if someone's going to get this business and they can't manage it, which could happen often, then they're going to have to hire someone to either run this company or fill those voids. And that could be significant with regards to industry in terms of what you'd have to pay that person. And payroll taxes are 15.3% because the person who's the employee has to have 7.65%, and then the business has to pay 7.65%. So you have to account for the payroll burden that you would have, plus the additional real salary that's going to be built into this business. You know, if that person who, you know, a spouse is running the business and it's going to be $100,000 for someone to run it, well, all of a sudden $32,000 is not realistic anymore, which may essentially bust the whole, you know, the whole operations. I don't know.
So in order to determine the actual income that your client or their spouse is receiving from this business, you're going to need additional tax returns, additional understanding of what creates these amounts to make sure there isn't anything confusing, understanding of why they were able to receive significant distributions, which we saw earlier, compared to income from the business, and how that impacts the business itself. What's the expectation for the future? That's what we need to know in order to have some sort of discussion on support.
Yeah, great point.
So Matt, I don't know if we should take questions on business tax returns or if we should move into our scenarios we had prepared.
Well, why don't we take questions on the business tax return now while we've got it up, while it's fresh, and then we can move into the scenarios because those are going to take us away from the 1120S.
So this is an exciting topic, don't forget.
Yeah, so if you guys have, you know what the problem with sharing the screen is that we can't see if people have their hand up or whatever. So I guess I'm going to say to the audience, there we go. Okay, are there any questions? Does anybody want to ask? I have a question. I don't see anybody with their hand up. Are there any numbers from the business tax return that we should be looking for on the people's individual tax returns?
That's a really good question. And I happen to have the individual tax return, so we can look at that. So just give me 1 second to open it.
Yeah, I mean, if that's part of your presentation, go, you know.
I mean, it wasn't necessarily because we don't have a ton of time, but let me show you. They're all going to come from one, which we looked at briefly. And yeah,
Yeah, they're going to flow from
the
they'll flow from that, to Rachel's point, the K1 is where that'll come from, which is.
It comes from the K1, okay.
It comes from the K1
I mean,
off of the 1120S, yeah.
That's helpful, thank you.
So here's the K1. You're gonna see this number, the 10,429.
Mhm.
This is the amount that they'll pay taxes on. The other thing that they'll pay taxes on are those wages that we saw from the 1125E. Okay, so let me show you the business tax return. Now, this particular owner has multiple investments. So, multiple K1s. I don't want to get too big. So where you're going to come find it. So here's the 1040 that is from the same person. You're going to find it here in 1 on line 8. See, it's a negative 175.
I
So
see.
it's kind of like you have to trace it a little bit. So let you go first to get to this line 8, and then you go to schedule 1. And then there could be multiple numbers, but in fact, we only have one number, and this is coming from schedule E. So let's find schedule E. There's schedule E. Now we have two. Here's the 175, and it's a result of $23,000 of income and $198,000 of losses. All going to be spelled out on statement 4. So let's find statement 4. I could go a lot quicker, but I don't want to give anybody a headache. That's statement 1. Well, statement 1, but while we're here, here's the wages. These are all the wages received. This is the wages from the business that we just looked at.
Got it.
And statement 4. So here we have non-passive income. This is what came from the business we just looked at. But the individual had additional non-passive income from another company and non-passive losses from 3 others. So that's why,
Thank
even
you
though
so much.
a lot of information.
I'm looking in the chat. We've got some questions in the chat. So David Smith is asking, what's the significance, if any, of retained earnings? How do we consider these?
So the retained earnings are very significant, and it's an important discussion because you can see retained earnings is on line 24 of the balance sheet we talked about earlier, 47,000, and now it's 99,000. So, what would be a good idea is if I had a whiteboard. So what we'll have to do is kind of imagine it, unless somebody has a whiteboard. Retained earnings is, if you kind of think about the word, it's earnings that the company made that weren't distributed, but actually retained in the business. So in years 2010 through 2019, they kept $147,000 in the business of earnings that were not distributed. Now in 2020, they distributed some of those earnings, and they only have 4,000 of earnings that were retained in the business. So it's important because in this case, they had a bad year, right? It was COVID, it's a tavern, it happens to be in New York, all those things make a bad year, but they had to pay their employees, they had to, do what they could to keep the business open. And so they had to dip into those retainage. So in years 10 through 19, we might, if this divorce had happened then, we might say, hey, you've made a bunch of money, you need to take it as income so that we can have it for support purposes. Well, it's important to know that they keep some of the money in the business for the purposes of years that are not as successful.
Yes.
Oh, sorry.
I was just going to ask. So my question about that is, if somebody's coming out of the business, then do we impute some of that as income to them? I mean, maybe I'm getting in the weeds here a little bit, but that seems like.
Tell me what you mean by coming out of the business.
Well, say somebody has decided they're going to come out of this business because they're not making enough money to be able to support 2 households now. So they're going to go get a job. So they are coming out of this business. They're not going to own it anymore. Would we say, okay, this has been your historic earnings. However, you've got all these retained earnings. There's 4 partners, 3 partners, or whatever it was. And, so some of this is attributable to you. I don't know if that's a thing or.
Yeah. I think
that's just my lawyer brain working.
Yeah, it's the value of the business that's that's going to be associated with this owner. So if he's going to somehow sell his ownership to other owners, so it's going to be what is owed back to him. So retained earnings is a part of that, but there's more to the value of the business than just the retained earnings. So that's kind of it is a more complex question. I would suggest if you have a business owner as your client or your client's spouse, and the value of the business you suspect is a significant estate, it might be a good idea to get a third CPA prepare a business valuation because it's an opinion, right? So it might put the financial neutral in an uncomfortable position to retain neutrality. So, but to get the value of the business, it's a lot more than just his 50% of this number or even this number.
So
Yeah.
just to keep things moving, Jennifer had a question, Jennifer Darley. I may have missed it. Where can we find the industry standards?
You can go to RMA, you can go to, you can kind of Google. You could also go to Value Source, VALUSOURCE. There are a number, of sort of periodicals that you can have access to. They're not inexpensive, I will tell you, to get
Yeah,
actual.
ask your financial neutral to get that information.
Yeah.
for you.
I mean, we could get that stuff for you, or should be able to, depending on who you're working with.
Were there any other questions that?
I think that's it.
One thing I wanted to go back to, if I could, real quick, is on the retained earnings. Just want to make a point about that, to everyone's point, that's a really confusing topic because it's really just the lifetime earnings history of the business. It doesn't mean there's money there. Just to kind of be clear, okay, which is a confusing thing. Retained earnings means someone thinks you have a bucket somewhere. That doesn't mean you have cash. For example, if you looked at that tax return, there's $150,000 of new loan money. So they spent that new loan money, which caused, likely that to go down.
So another thing is retained earnings as a mathematical equation are your total assets minus your total liabilities. So
Right.
This company has a bucket of $135,000 in cash. And that's it.
Right.
And they have some inventories, a couple of fixed assets.
And Rachel, maybe well, just to mention, I guess, and I don't know if you want to tag onto this, is that remember that retained earnings is not their basis in the company because of, they could have taken money out in other ways. So that retained earnings is just not what their ownership value is anymore. Which is why this stuff becomes kind of confusing because you have sort of the financial accounting, tax accounting, and then, okay, what do they really have in the business that they can take with them or get paid for is different.
And Brad and Rachel, with those retained earnings, is it a fair understanding that they're taxed on them in a prior year? So therefore, if there is still cash in the bucket and they
Correct.
draw it out this year, there's no income tax on that withdrawal.
Correct.
Absolutely.
That's exactly
And how
right.
would you treat that for income purposes if you're trying to calculate somebody's income? Would you consider it all?
Yeah, so you have to make the decision as you're looking at this. You can't take two buckets, right? So I said to you earlier, one thing you need to consider is going to be, owner's compensation, which is listed here, but also on 1125E, and it's also going to be on, a W-2. Another thing that you have to consider is going to be the business income here. So maybe your client's ownership percentage and the compensation, right? So that's one slice. The other slice is going to be the distributions. You can't do both.
Right.
So you have to decide now, and that's why it's important you get multiple years because it's possible that this company's made significant, I suspect, made in New York, and that they made $1 million in 2020, but they make significant income, right? So you have to look at a few years to see what is the expectation for income in the future. So a lot of times they can distribute that income and you look at distributions. A lot of times it depends on, you just want to look at previous years too, because maybe they know they're getting a divorce and they're going to stop distributing money. So work with your financial neutral on that.
And Brad and Rachel, when you're trying to figure out a party's income who has a company such as this, what's the significance of looking at the general ledger in determining what their income is?
Well, the general ledger would tie to the actual business operations. which, Rachel was mentioning at the beginning, is that you want to make sure these allocations are even right. That's where I start. Just because they're on a tax return doesn't make them gospel. I know they're filed with the federal government, and so you're filing them under penalties of perjury. That's true. It doesn't mean they're right. I mean, a lot of returns are filed incorrectly with these size companies. I mean, until you get to companies that are $20, $30 million, I mean, my experience is there's a lot of bogus returns out there. They're not tied out properly. They're just, thrown into the fields, and we all pick them up as that's what it is. But that's not necessarily true. You can't the financial accounting is what derives these numbers. That's what's supposed to happen. So you really need to keep that in mind with respect to looking at the history of the general ledger, to Matt's point and what Rachel mentioned earlier.
So the ledger is going to be all the transactions that come together to create these numbers. And they're very important, like Brad mentioned, because they may be miscategorized, and that might make a difference in how you feel about the income of the business.
Yeah, there's a comment from Ed Sachs that you need to look at the general ledger for personal expenses, and he saw employee training as a deduction. And then he looked at the general ledger and saw that expense was really the child's private school, which would be a personal.
Well, and an interesting point that makes me think of that Ed's bringing up is that you could have shareholder loans, meaning he borrowed from or she borrowed from the company. So now there's a receivable because essentially owner takes a loan from the bank. They get working capital, but they pull it out through distributions. CPA reclasses the distributions as shareholder accounts receivable. Now they've taken the money that was borrowed by the business out personally. They're showing it as a loan, but there's no promissory note. There's no imputed interest. And so if that ever has to get paid back, the government's going to say it's all taxable income. So, I mean, those are things you need to be aware of with respect to your clients, because depending on who's on what side of the fence, it could be a huge number. A lot of times people are just siphoning out the money and they're just calling it a loan, and it's not even classified that properly.
We have another question from Michael. In collaborative divorce, when valuing a closely held business using the net earnings approach, what are your concerns about using the same earnings stream to figure out income for support? Do you have a clear way to explain the double dipping to, one, the spouse who retained the business, and two, the spouse expecting a payout in either equal distribution or in support?
So double dipping is a big controversial topic. So I'll refrain from discussing that. But let me tell you, okay, first of all, it would be your best interest to keep neutrality by asking a third party to do the business valuation. So that's going to be the asset that you as a family unit has generated during your marriage, right? You generated this business and it's an asset, just like your home. Now, that's going to be, I would suggest, have the financial neutral identify a third party to develop a value on that asset. The income that's produced out of that asset may or may not be the same methodology that the evaluator used. One thing that you can do, if you want to talk about how you can talk about this with the parties, the spouses, is you can say, think about another company that we're all familiar with, like Coca-Cola. If one of the parties owned a share of Coca-Cola, they have two things. They have an asset and they have dividends and income received from Coca-Cola. So this is not different. It's just a smaller company. Does that answer the question? I don't know who asked it. Somebody in the
Michael asked it.
Okay, so do we want to move on to our?
Let's move on to our scenario. So Rachel, if you could stop sharing screen, and I will share. What we've done is we may not have time to get through them all, but we've come up with a couple factual scenarios that came from real cases and that involve unique tax issues, and just kind of let you see kind of what happens out in the real world and get some point on how you would approach this. So this first one is you have two parties who have a child in common, never married, but for 7 years, they filed married joint on tax returns. mistakenly believing that they were common law married. They buy a house together, and because their tax returns show that they were married incorrectly, they're both listed on the deed and the mortgage. And when the relationship ends, they're going through paternity action, and they're in the collaborative process. The father wants to buy out the mother from the equity in the house, but they can't do it because it's discovered that the tax returns falsely reflected that they were married. What do?
File amended tax returns.
How far back can you go on an amended tax return? Brad, you're raising your hand.
He was putting up his number.
Putting up the numbers. 3 years, 3 years, unless it's fraud. If it's fraud, it's I think it's 6. If it's willful, it's indefinite, or if it's fraud, it's indefinite. I forgot. It's either 6 or indefinite. But fraud, if you're off 25% of what you owe the government, that's fraud. If it's 50%, it's I think willful fraud under Title 20 something.
Any other thoughts on this one? I mean, Bob had said file an amended return. We can do it at least up for the last 3 years, since this was a form of negligence on their part. It doesn't sound like they were intentionally being fraudulent. Move on to the next scenario. This one's got multiple parts. So you have a family business that provides the entire support for the family. This is actually a case that Rachel refers to as a unicorn. Husband and wife are both listed as officers of the family business and employed by the family business, receiving W-2 income. It pays for all of their personal expenses out of the operating account, and they supplement their lifestyle using the business account to the extent they can't fund it from their wages. They haven't bothered to file any tax returns, unlike the people from the prior one. And so no business tax return, no personal tax return for at least the last 7 years. They're now in a divorce.
And a good one, a good divorce.
What's the significance tax-wise if the ownership of the company is in one party's name only as a shareholder versus being held 50-50? If any.
Do you mean that if it's 100% with one shareholder after
Correct.
the divorce?
Or before, well, before, what's it determined prior to any kind of settlement for tax purposes?
Yeah, for tax purposes, if it's 100% in wife's name versus 50% wife husband in terms of actually holding shares as opposed to the marital equitable interest,
Would
does it
it,
make a difference for tax purposes?
well, it would make a difference if they filed married filing jointly versus separately, wouldn't it?
Brad,
Because if
Rachel?
one person is 100% and they do married
Correct.
filing separately, then the person who's 100% takes on all the tax liability. However, if they filed jointly, then they share the liability no matter what.
Mhm.
That's on the personal side, correct. And then on the business side of the equation, in terms of what are you doing with the business? If you're selling the businesses, for example, right, that's huge, because either someone theoretically owns 100% of it or two people own it.
Mhm.
And then you go back to this basis conversation we had a little bit before, is what's the value that somebody has in order to determine capital gains? Because if you're selling something, let's say for $5 million, how much do they have vested in this company that you can explain to the IRS how you came up with that number? Because that is going to determine what the capital gains exposure is. So if they have $1 million in basis, single or together, and now they sell it for $5 million, you got $4 million in gain. That's $800,000 in taxes.
Would there be capital gains off 7 years business?
Well, yeah,
Or
there's
there would
capital
be.
gains from, yeah,
I'm
that's
thinking
okay.
of houses.
No, yeah, that's a good, no, that's a good question. No, you're right. I mean, it's fair. It's that, yeah, I mean, from the time the business began, right? Whatever they put in, whatever income they generated, whatever money they took out, all that, generally speaking, gets netted, and that's sort of their value. But the question is, did the wife own a part of this or just the husband? Because whatever case you're making for is a significant impact to how you handle this collaboratively.
Mhm. The next part of this, what would be the change in your analysis, if any, if a portion of this was non-marital to one of the parties, as opposed to being 100% of a marital entity?
Hmm.
So just come back to who's going to eat the tax bill.
I think that's the primary concern for this scenario is you're working with parties who have not filed their tax returns. And so you've got to rectify that situation before you can identify, first of all, if there's a capital gain. Without understanding a basis like Brad discussed, you don't know. I mean, maybe they could be selling the business for a loss. They could have dumped a bunch of money into it and maybe it hasn't made any profits. I mean, there could be valid reasons for not filing a business tax return. Actually, that's not true. They have to file.
I was going to
have
let
to
you
file.
go on that, Rachel.
You walked that back
No,
quick.
there's not. They have to file the tax return. If it's
Right.
a corporation, they have to file a tax return.
Right.
If
The one
it's
thing-
not incorporated and is a pass-through entity, and they don't make any money, and it's on the schedule, to file a tax return, Brad?
Yeah. Yeah. In other words,
No
yeah.
income, no income. from the
If you get a K, you're supposed to report the K1, as I understand it, honestly. You got to report that if you have a business that's operating, even if it made no money, but it has operations, that K1's got to be generated and then included in
But
there.
I'm not talking about a K1, I'm talking
Oh,
about a Schedule C.
Oh, a Schedule C, it's $400 or more. They have to report it.
$400 net or gross?
Net, I believe.
What
If
if
you
they
had-
had $400 loss with
I believe that has to be included. Yeah, because ironically, Schedule Cs get audited more than the S corps,
well, yeah.
right? I mean, it's just like that's where. I mean, we have some people running $2 million through a Schedule C, and I'm like, are you crazy?
Yeah.
Like, why would you even do that? Why would you have them ask to audit your return?
Ed asked a question in the chat. What if the parties don't want to file the returns? Can you
Well,
continue the process?
they're not my client then.
Yeah, you're gonna have a difficult time getting a financial
Yeah.
control.
That's
I
not going to
believe.
happen. That they're being adversarial with you essentially in the government. That's not a client I would work with.
Yeah, that's not good.
Yeah.
Next,
And the other thing, Matt, I just want to say real quick is the fact that they haven't filed their personal return for so long. I mean, I don't know if Rachel experienced, but typically we find when we do our IRS representation work and tax advocacy work up to petitioning tax court, I mean, those can be the worst clients because it's indicative of everything is all screwed up essentially. I mean, their books are bad. They don't have any books. They haven't filed their tax returns. You guys are trying to get affidavits and those are basically garbage because they're like pulling stuff out of the air and they get questioned when you start, going through the legal process.
Well, let's jump to the next scenario because you just kind of brought it up. Scenario 3 involves kind of appealing to the tax board and dealing with that. You got a post-judgment situation here where there's an alimony award and the recipient of the alimony fails to pay income tax and accrues a debt with the IRS and their recorded tax liens. The IRS levies upon the payor to garnish the alimony payments owed to the obligee. And the notice of levy directs that all income owed, doesn't say an amount, be paid over. What do you do? What can you do in terms of advising these people in the collaborative process to try to work a way out where they can see some daylight?
Yeah, this is a tough one.
And what can you advise the person who owes the taxes? What can you advise? What are the issues for the person who owes the alimony?
Can they require that all of the alimony be paid over? Isn't there limits on withholdings?
Brad?
Well, when you say require, who require who?
Well,
Who you
The
asking to
IRS
require?
requiring the former wife to pay all of the alimony payments over. Isn't there withholding requirements?
Well, they should be able to garnish those dollars. But what's happened historically is the wife in this scenario is not working with the government, essentially ignoring notices,
Oh.
essentially unwilling to be a compliant taxpayer.
Well,
is what
Brad, I
happens.
switched the genders in this scenario.
Oh, sorry. Okay, well, the reverse.
So
It's a very flexible world these days. I don't think it matters anymore. But the
I guess
gender.
what I meant was the payor receives the
Right.
notice of levy.
Right.
Typically, when we're garnishing wages for child support, alimony, or whatever, you're only allowed to garnish so much of it. So the payor, would they also only be required to send over a certain amount to the IRS?
Well, I think you may be talking about the federal garnishment statute that would normally apply to garnishment
Yeah.
of wages, but the
Yeah.
IRS is on a different tier.
Yeah.
That's what I was
Yeah.
wondering.
And
Yeah, that's where I
in
was
this
confused at,
particular
yeah.
case that Brad and I had, the monthly alimony payment was $18,000 a month, and the IRS was asking for 100 cents, 100 cents on the dollar.
Right. And we were
And it was
concerned that
kind
if it was paid to the spouse, it's not getting remitted to the federal government, then the person paying the alimony is going to pay double because
Why would that be the case?
they're still levied. Because if the person doesn't remit and they already have been levied for the dollars, the government's going to go after that person who they've already to use the word loosely, legally have attached to their property. So they're going to force that payment from that person because they're the ones that they think have the money.
And there's actually a federal statute in the IRS code that says exactly what Brad said, that if you are levied and you avoid the levy, not only do you have to reimburse the government what you didn't pay them, but you have to pay a penalty of exactly what you avoided. So it's double payment of the alimony to the government for having sent the alimony over. The recipient of the alimony in this case, how would they get recourse in terms of either a lowered amount of the garnishment, Brad, or being able to resolve the tax bill entirely with the government? What's the process? Because you mentioned you do this kind of tax representation.
Yeah, so what you could do is determine what their ability to pay really is. I mean, you can negotiate with the Internal Revenue Service depending upon age of of your client. You know, we have gotten people out of tax liabilities, not just the penalties and interest, up to about $385,000. When we've made the case that this is never going to get paid. So let's come up with a real number, depending upon the age of the client and what the resources really are, and establish a real analysis that the government can live with, because they want to settle these things as well. You just got to get to the right people, which is sometimes difficult when you're dealing with difficult revenue officers or revenue agents, which are which can be the worst of them. Depending on who it is. Some of them are very, very easy to work with. Some of them are just really hard-nosed. But that's, that would be the way to do it, to work with the government to try to get a payment plan or, try to minimize the amount of actual tax exposure. And there are ways to do that. They're not always successful, but you can be very successful at that. And that's a way to do it. In this case, as I recall, our recommendation was to pay the money directly to the federal government. That should also satisfy the alimony, because that money needs to go to the government anyway. The fact that the person receiving the alimony doesn't want to keep on sending it to the government is not the other spouse's fault or ex-spouse's fault.
And that ties in with a federal statute that's in that same area of code that says if you comply with the levy, you are protected from any contractual or lower court obligations to do otherwise. So technically, under federal law, you are exempted from paying the alimony to the recipient spouse if you pay it to the IRS pursuant to the levy. But a lot of times you may have a state court level judge who may not necessarily agree with that. Jeff Wasserman asked whether you could put the money into a court registry to avoid the penalty. And that's actually what happened in this particular case. Was we ended up in federal court trying to bring the IRS in because we couldn't work it out. As Brad said, the recipient of the alimony was not very cooperative in wanting to deal with the government. So we had to bring the government to us to kind of get everybody to work together to get a global resolution so that the money could be paid and nobody had exposure. And the final scenario, if we've got time for it, although we've only got 5 minutes left, this ties back to that business tax return. You've got a self-employed person, and instead of the situation that Rachel described where you've got multiple people in the business, you have a single-owned business. And the financial neutral reviewing the tax returns in those financial schedules determines that there's been a substantial amount of in-kind payments coming out of the company that would be income, such as Ed noted, private school tuition and other things that are not being properly reflected on the return and classified as income to the individual. How do you reconcile that with the K-1 and the tax returns? And at what point do you ethically run into a problem as the financial neutral when you come up with what's probably a problematic tax return? Rachel, you're muted. I think you were about to speak.
Thank you. Are there any financial neutrals in the audience today? I'm curious to know what someone else would do in this situation. So yeah, you'll need to work with your financial neutral, but usually is there someone else?
I was just gonna say, isn't it true that what you can take off in the taxes isn't necessarily what the state recognizes? So it's not necessarily that they would have to amend their returns depending on if they properly took off deductions. It just means your income would be calculated differently for support purposes.
That's exactly right, Jennifer. But if there is a case, kind of like private school tuition, that it's clearly not a business expense, you may need to talk to your client. They're both your clients in a financial neutral situation. That this is not an appropriate deduction, and there's some serious ramifications. And then as a team, you can decide how to treat historic tax returns. And then I would advise my clients on future tax returns a proper treatment. So as a team, you can talk about what to do, because this could have a future impact on both parties, on both spouses.
Mhm.
So it's important to discuss it as a team. The neutral should bring it to the team and say, this is what I've observed. Distinguish the difference between a legitimate tax deduction, like your cell phone or your auto, that is also an in-kind income to one of the spouses. Right? So you'll need to talk about that to the team. In one case, it's certainly not a business deduction, and it is an improper characterization and could potentially have some ramifications in the future. So the team, with the assistance of your facilitator, should really discuss how that should be handled.
Thank you so much, Rachel, and to our entire team. It's there's 2 minutes left, and I know our fearless leader, Mr. Merlin, wanted to have a couple moments to make some announcements or kind of end our meeting today, our session today. So if it's okay with everyone, I'm just going to turn it over to Bob at this point.
Thank you, Kelly. I appreciate it. So I'm very happy to see so many people on this call. Every single one of you are interested in becoming the best possible collaborative professional you can be. Otherwise, you wouldn't be spending your time and effort sitting during this grand rounds. Hopefully, you plan on attending our 10th annual conference, which will be June 9 through 11 at the JW Marriott Tampa Water Street. I put the link for registration in the chat. We really hope that all of you will attend. Some of you are already sponsors of the conference and you're registered. Some of you, no doubt, have not registered. Please register. It's the best way for you to really engage with other collaborative professionals in person from around the state, hear great speakers, and have a good time. So I hope to see you there. I hope you're going to join us. Thank you, Kelly.
Kelly, if
You're
you're
muted,
speaking, you're
Kelly.
muted.
All right, so on behalf of FACP, we'd like to thank our presenters. Great job, great information. And please remember to send us your suggestions for future grand rounds, and that there will be no grand rounds in April due to the World Creativity and Innovation Week, which we all hope that you're all participating in with your local practice groups. And we will, please check the FACP website and your inbox for information on May's grand rounds, and happy spring, Easter, Passover, whatever it is you're celebrating in April. Thank you, everyone.
Thank you.